Good afternoon, gentlemen. How are you?
Hey, Cass.
Cass, how's it going?
Everyone.
For those of you new to our YouTube channel, we are Meta Mortgage Group. So welcome to the team. I'll just go around and introduce everyone. Start off with myself. I'm Cassandra Forte. I'm a mortgage advisor at Meta Mortgage Group. I'm going to go in order of my screen, not in order of importance, with our first up, Vince Scarcelli, our principal broker. Hi, Vince.
Hello. How's it going?
Then we have Matt Arruda, another mortgage advisor with us.
Hello.
And our who we call Wonder Boy, our junior chief economist and mortgage associate, Nick Papuga.
Save the best for last. Thanks, Cass.
That's right. That's right. So obviously I keep roping you guys into these calls because I'm really trying to beef up our YouTube page and get a lot of information out there. And I appreciate you guys taking time off the phones because I know they're ringing off the hook right now, talking to our clients just about the current industry and reviewing their goals. So I appreciate it. Thank you. I really wanted to do an update today on our last YouTube video, which was called Rising Interest Rates, What's the Scoop? And that was following, I can't remember which one now, but one of Bank of Canada's rate announcements. And we know that there's another one coming up. So I really wanted to just kind of answer the common questions we're getting, do a bit of an update from that call, and talk a bit about what our team is doing on the inside surrounding this current market shift. So Vince, why don't I pop it over to you to talk about kind of what you're hearing in the scoop over there.
In the weeds?
Yeah.
So I guess we're going to call this a part two, right? Because this is like rates continue to rise. We're seeing that. We saw the beginning of September. And I think we can all expect that rates will continue to rise, at least in the short term. All the economists are calling it. Our chief economist here at Dominion Lending, Sherry Cooper, is right now forecasting about a 0.75%, so 75 basis point increase at the end of the month. So that would then effectively bring prime up into the 6th percentile. So that's taking us from a current rate of 5.45% right now, which is pushing it for sure. I mean, think of where we came earlier this year to now, and hence why we are receiving a lot of phone calls and a lot of inquiries, and we've created content towards addressing this because we really want to inform people and help people at this time where they need to either hear from us and also sort of get an idea of what to do. We're getting a lot of calls about, what should I do? Where do you see this going? So none of us have a crystal
ball question we kept getting.
Yes, we do keep getting that. Everyone's getting that, and if anyone had it, they'd be super wealthy right now. But all we can do is really take this opportunity to keep in touch with our clients, reassess their needs. And also what we're actually doing is Nick has been putting together some pretty cool graphs as well. So looking at data trends, looking at the past and see how this is, what has occurred in the past, and see if it could oftentimes, history does repeat itself. So we're looking at that, looking at trends, analytics, if you will. So we're taking the sports end of it and kind of, taking that approach towards the analytics in the mortgage industry. So I'm sure Nick will talk to us about that in a little bit as well.
Great. Well, why don't we just jump right in? Because I love hearing and seeing. I'm not a stats person, so I'm always very interested when you guys explain this. So why don't we shoot it over to Nick, and he can, I know he's put some data together, he can explain kind of what they look like and what we're trying to capture here.
Let's do it.
Yeah, that sounds good. Wait, let me just share my screen here. Okay, can you all see the graph?
Yeah.
Beauty.
Okay, so what we have here is there's 4 lines on this graph. Starts in the year 1975 and runs all the way up to September of 2022 today. We have our variable, fixed, prime, and our inflation, so our CPI numbers.
Okay.
So if you look throughout history, we can see that generally all of our variable, fixed, and prime rates are above the inflation numbers. A few times in the late 70s, where the inflation numbers are greater than our prime and variable interest rates. And what follows is a rapid increase in all of those rates. So what we have today we are right over here, if you can all see my cursor, our inflation rate is greater than our variable fixed and our prime interest rate. So without being able to fully use the crystal ball, we can use that to predict that rates will rise.
Right.
And where did you get all this data from? Where did you source this from?
Our inflation numbers are from Bank of Canada. Our variable and fixed and prime numbers our prime numbers are from Bank of Canada, of course, and our variable and fixed are actually CIBC CIBC historical rates,
which are usually fairly competitive with everybody else. So it's a pretty good average.
Yes.
Yeah, it's hard to get. Obviously, there's such a wide range of lenders and rates out there. So, Nick, you did a great job putting this together. The thing that concerns me when I'm looking at this, one thing that does concern me is the fact, I think this is what's concerning really all of the economists out there, is you can see that the CPI number is significantly higher and rapidly jumped higher than all the other rates. So by sort of conventional economics, it should be expected that rates can rise or should rise to a point where it's going to sort of rise above or set above the CPI numbers. Now we've noticed, and you can't see it in this graph, right? There's another graph that you've produced, Nick, that shows that the CPI numbers of where they are most recently, and we do see them coming down, which is a good sign, right? So yeah, this is a cool graph, and we'll be doing more of this stuff.
I think what I notice about this graph is that people have been really freaked out that the rates have risen so much. And I think we talked about this in many of our videos. A lot of people got really spoiled with these very, very low rates that were offered through COVID, that really, it's not realistic to expect to be borrowing hundreds of thousands of dollars to purchase a home for 1% interest. That is also unrealistic. And so the rates have shot up very quickly, which has scared people. But if I look at this graph, what I'm seeing is the rates are still a lot lower than they've been historically. We are not at historical highs yet. Hopefully we won't be, but they're really not, in the grand scheme of things, gotten completely out of control. I think it just happened in such a short period of time. Right. If this had happened over 10 or 15 years, you absorb those increases and it just feels less impactful. It's the speed of it, which is a little bit scary. But I think it's important to note that borrowing money, there's always going to be a cost to it.
Yeah, it's largely, I think, the big picture of everything altogether. You certainly have these rates that, to your exact point, Cass, we're not concerned about the number per se. The rate itself is not drowning any other number that's come before it. Those rates that we saw 12 months ago, 18 months ago, they were called emergency rates for a reason. They were utilized at a time that none of us had ever lived through before. So they had to get there to kind of see it through. But I think what's compounding that now with these rates going up, not so much going up, but to your point, with how quick they're going up, is you're seeing a lot of everything else surrounding everyday life also going up. And I think there's a lot of fear mongering that we've also seen come across various forms of media and all the rest, with a lot of worst case scenario situations where maybe these kinds of graphs might do exactly what it's meant to do, to try and help clarify things with what it really can, or where it really does look like, as opposed to where it's been in the past.
Right. So you mentioned inflation. Vince, you also said on the next graph that Nick will show us that inflation is starting to come down. Now, is it the theory that these interest rates were brought up to control inflation? And if so, is it working?
Maybe you could pop that graph up, Nick. Have a look and see if you can do it. Let's look. Yeah, there it is. So we can see this is basically, I think, a year-over-year comparison of the CPI. It's the orange line. If you take a look at it all the way to the end, you'll see that it's reached a point what looks to be like a peak, and now year over year, it seems to be coming down. The theory is that these rates, as you ratchet them higher, that the rate of inflation will start coming down. It seems to be happening. So making things more expensive in and around, so making life more expensive would actually slow demand, which would then, of course, reduce price. So we'll see if that is sustainable, but it looks to be that it's starting to at least ease it off. The rate or not volatility, but the rate of inflation at which it's growing essentially seems to be leveling off.
I think it's hard for a lot of people to understand, how does making things more expensive help me? And of course, the Bank of Canada is making decisions for everyone. But I do understand that this circles back to people's personal budgets. And that's what us as mortgage advisors and mortgage brokers, when we're talking to our clients, we're not worried about the masses and what this is doing to overall inflation. We're most concerned about, what does this mean for the client? Does that mean they're still in the right mortgage? And we are taking steps to kind of readdress that and just circle back with our clients to just touch base and make sure that they're still going forward in life on the plan that we'd set for them when we set up their mortgage, and if changes need to be made. So Matt, maybe you can, I know you've been on, I was off for the last couple of weeks, so you've kind of jumped in this before I have, but you have been reaching out to some clients, as we all will coming up to talk about this. Can you talk a little bit about the process that we set in place and kind of what our goal is here?
Yeah, absolutely. I mean, and it's probably important to note that we want to be able to talk to people during times like this, during this situation. We're not putting our heads in the sand and hoping this kind of goes away and rates start to come down and that's it. So there is a process in place that we'd like to be able to share with people, and that we encourage, if you don't hear from us first, which we are currently working through, we still welcome anybody and everybody, clients of ours now or otherwise, to reach out to us, and we'll be happy to kind of discuss what this process looks like. But we go into these meetings kind of ensuring that we know where you currently stand. What does your current rate mean? What does your current payment mean? I'm sorry, based off of what the rate is at this stage versus what it was when you first signed up. We want to talk about things like your long-term goals versus your short-term goals. So the time horizon, things like, when you plan on staying in this home, are you still thinking of potentially investing in rental homes or other business opportunities the way we may have discussed 2 years ago? We also want to talk about things like cash flow and how that has certainly changed, more likely than not, 2 years ago, 3 years ago, to where it is now, certainly based off of things like we discussed with inflation going up and such. We know there's going to be there has been a bit of a crunch on that end for most households that we should chat through. And then once we have a good feeling as to how this is all moving and a good handle as to what those goals are and those expectations are for every individual household and client, we try and explore some solutions. Sometimes it's just leaving it as is. Other times we're talking about different types of debt consolidation, whether it be with a refinance or maybe even a small private mortgage that we can discuss or speak to. And then we'll talk about that suitability and whether or not that suitability is good for more than just the right now, because affordability is good, right? If affordability is good right now for where you're at, maybe there's a discussion to be had about playing out the length of time before we look at making any drastic decisions. But the point is, we do have this review process that we lean on, and it's helped us and helped clients feel a lot better about their situations moving forward, I'd say.
So just to clarify, because some people watching might not understand why different recommendations would be made. You mentioned refinancing or a private mortgage, like a private second mortgage. In what cases would that be suitable for a client?
Well, things like refinancing might be a good way to reset the scenario from a cash flow perspective, right? Where you might have had different debts accumulating over the course of the last little while, and if cash flow is an issue with keeping up with these different costs associated, refinancing and consolidating these different ways or different expenses into a one smaller payment in the way of a refinance might help on what might be some other higher interest cost charges that you would otherwise be carrying over the course of the next little while through what is an escalating interest rate market. So again, it might not be the best scenario for you in particular, but things like that might be a good option to help just release the lever a little bit and kind of give a little bit more cash flow back into clients' hands, at least to kind of stem the tide, as it were.
Another great point, I talked to a client recently about this, to your point, to reset numbers. So to refinance to consolidate some debt can alleviate payment pressure, but also refinancing gives you an opportunity to re-amortize, which can make a payment change. So what does amortize mean, and how does that affect your payment?
So if we're talking about amortization, traditionally speaking, we see a lot of our mortgages be set at a 30-year amortization. And it goes without saying, the longer an amortization is, the smaller the monthly obligations are going to be on that mortgage amount. So to your point, if we have the ability to refinance and essentially reset the table, we could potentially be looking at resetting not just the overall debt amounts or the amount of interest that one's paying accordingly, but then resetting it over a fresh 30-year period starting from scratch, so that that number could then be realized at a smaller amount. You'll have a slightly smaller balance now spread over that longer 30-year period. Of course, it equates to a smaller monthly payment, which, if the goal is to increase household cash flow, it's a great way of considering it.
Yeah, and another great feature that I've mentioned in these re-amortization discussions is repayment privileges, because I've had people say, like, why would I re-amortize? Like, the whole goal is to pay off your mortgage quickly. So by expanding it by 5, 6, or 10 years to over 30, that'll alleviate the pressure now, but then I've got this mortgage forever. And I always like to point out that we have repayment privileges with each type of mortgage. It's usually roughly 15% of the original principal every year, plus you can double up payments at any time. And there's features like that. They can vary from lender to lender, but there's always some kind of. So I always mention that should things change for you, inflation comes down, life calms down a little bit, things aren't as expensive anymore, or let's say you get a new job and you're making more, you can control your amortization by making lump sum payments.
Absolutely.
Right? And get that amortization back down to where it was, but at least you will have alleviated some pressure kind of during the tough times right now. So it's important to speak to a professional about these things, because those are things you might not remember from when you set your mortgage up 3-4 years ago, that we can just re-highlight as options for you.
Yeah, that's a very good point. I say the same thing. And amortization is a great guideline to know what your minimal monthly or biweekly, as it might be, obligation is going to be. But the reality is, for the most part, you're truly the one in control of your amortization in the way of whatever those repayments might look like over and above those minimal monthly obligations. So if you are going to double up, if you are going to put a lump sum down to the tune of 15% of your initial principal amount, and in some cases with some lenders, it's more than 15%. So you can really make a dent into some of these things, where 30 years can turn into a hell of a lot less than that, depending on how disciplined one can be, but also from a opportunity or affordability standpoint moving forward, what you can do to it.
That's right. So another option you mentioned was, staying the course, but let's say we do deem that the best option is to switch from the variable that you're in into fixed. Does somebody want to talk about what the implications would be on locking into fixed and what that means? How do we figure out what your new fixed rate would be? Okay, crickets, who wants to take this one, guys?
You've heard too much, and you guys are going to be bored of me.
So basically, I'll jump in on this one. So when we're going to recommend a flip into a fixed, there are different ways, of course, right? One could be with the same lender that we're currently with, and that would mean coordinating with your current bank, and we would take a hand in that and making sure that, of course, there's an opportunity to do that. And that would basically be negotiating a current fixed rate at a term greater or equal to the remaining term is typically what is the requirement. And that means that we're not touching the current balance. We're not changing the amortization. We're not doing anything. It's just basically flipping into from a variable rate to a fixed. at the current fixed rate. It's also something really important that people need to understand, is that we're not fixing your variable rate or the rate that you're currently paying in a variable rate. We're fixing it in a fixed term at a rate that's currently available for that fixed term, right? So that's really
You mentioned
important.
this wouldn't change your amortization, but it might change your term. So can you expand on that a little bit?
Yes, good point. So for example, if Nick has a mortgage that has 44 months left to pay, now by definition of flipping from a variable to a fixed, Nick would have to take a 4-year, which is 48 months or longer, right? A term greater or equal to the remaining term. There isn't a 44-month term, does not exist. So the next larger term would be 48 months. So we would then go and take a look at the schedule of rates of what's offered for a 4-year fix with that bank. And then that would be the option the client would have to be able to switch into the fixed rate without cost, without penalty typically. So most lenders won't charge a penalty or cost to do that. And in most cases, you are accepting a slightly higher rate than what you're currently paying right now anyways. So it kind of offsets what would have been typically a penalty if you were to go elsewhere.
So if you do decide to go fixed, what are some things that you should be aware of that you're now agreeing to with the fixed?
Well, you're agreeing to, as I mentioned, typically a higher rate than what you're currently paying in a variable rate. And you're exchanging that for stability in payment, obviously, right? Because that's what the fixed rate is going to do. The most important thing that people need to understand when they're flipping into a fixed rate is that their prepayment privileges will change. And that is probably the most taxing, or something that many people kind of underestimate. And that means that if you go to, if within that remaining 4-year term, that we'll use the same example that we talked about with Nick. So he flips into a 4-year fixed. If he decides to break this mortgage within 4 years for any reason, such as he decides to sell the house, or we have to do a refinance and break the mortgage, he now is in a different, his penalty to break this mortgage changes. That calculation is different. The calculations turns into from a 3 months interest penalty, which is the variable rates way to calculate a penalty, to either a 3-month interest penalty or what is called interest rate differential, or IRD, as is widely known within the industry. That is a differential in interest rates. It's a way for the bank to hedge their the costs that they've accepted on a fixed rate. And really, generally speaking, it's a significantly higher penalty than the 3 months interest. So that is the biggest thing. It's kind of like a back end loaded cost that people don't anticipate, don't even think about. In fact, most bankers don't even talk about when they sign clients up for a fixed rate. And that most clients just find out at their lawyer's office when they're signing for the new mortgage, or they're signing to discharge their current mortgage, and they go, what is this huge cost? 12 grand, 15 grand, 20 grand. And it's the cost to break that fixed rate mortgage.
So this is where we are talking to clients to what Matt was talking about when we are revisiting suitability. When we're deciding if that fixed rate is a good idea, we're asking about your future, because we want to prepare you for what that penalty could look like if something does change, if you sell the home or need to refinance. So I've had a lot of calls end with, give it a couple days to really think about what your plans are going to be, and get back to me. Some people who had plans to move, and that's why we had them in a variable, and now they're deciding. It's like, well, a year ago you said you were going to move, now you're unsure. So like, let's really think about it for a few days before we make a decision on this.
And that's why that whole question that we all receive of what should I do? Should I fix? Is such a loaded question. Like, there is no way that we can just say yes or no. There has to be an analysis. There has to be a discussion. And that's why, as Matt laid out, that's what we're having with every client. We have a long list that Nick prepared for us that we'll be tackling, or we are already tackling. We've heard from many clients, and we are having those active discussions. It's a 7-step process that we've developed to be able to do a proper discussion around suitability, and a numerical discussion to find out what does the math look like for this client?
I wanted to go back. You said when you were talking about what it means to go from your variable to your fixed, that likely you will be paying a higher rate with fixed. What is the difference in the rates right now, roughly?
So right now and again, we're, there's this whole variable, not variable, insurable, insured, and uninsurable. Let's just use uninsurable rates. These are clients in 30-year amortizations, as Matt was mentioning. So you would see something in the 5-year fixed rates at 5.5, okay, and your 5-year variable is just above 5. So we're seeing, and I know you're probably going to touch upon this in a minute, is you're seeing that the spread between the variable and the fixed is narrowing significantly, right? Like 6 months ago, it was over 2%.
Yeah. You knew exactly where I was going, because the reason I'm asking is because I've had a couple people we've spoken to now, and we've spoken to like 6 months ago. 6 months ago, we had the same discussion, and it was deemed that they should stay the course in variable. Now, some of those decisions have changed, and that spread is a factor in that. Where were the rates 6 months ago, and kind of what savings would they have incurred over this time? I know you did a bit of a case study.
Yeah, I did a case study for a number of clients, and basically what we came to look at is these clients were, December of 2021 is when we dispersed their mortgage, when they took out the mortgage, and we ran numbers on. The question was like, Vince, why didn't I take a fix? I should have. At the time, both were available, fixed or variable, like with every client, and they wanted to definitely go with the prime -1, which took them to 1.45%, as opposed to taking a 2.65% fixed. So I ran numbers. I said, well, why don't we just look at some numbers and break it down, right? And see where we would be today. And even today, as it stands, they're still ahead, meaning that at that 1.45% from December of 2021 through to when we started increasing rates, first in March of 2022 and then beyond, that they cumulatively still have spent less money in payments than they would have had they accepted 265. Okay, now going forward, we don't know what the remaining 4 years holds, but we do see that gap narrowing. Okay, then we also looked at, well, in July when we spoke, and you asked about switching, maybe I should have switched then, and why didn't I? Well, fixed rates in July, many of them were pretty much the same as they are today. In fact, the 5-year fix has stayed pretty flat since then. So our argument at the time was there's still a big gap between the variable and the fixed. At the time, prime was 3.7, so this client was at 2.7, and fixed was at 5.5. So naturally we're saying, geez, do I really want you guys to like effectively double your rate of interest in order to have security and payment? So for most clients, we really did discourage that. And had they taken that fixed, which is effectively flat today, they would have spent an additional $2,000, just over $2,000 based on our example. So again, they would have been out of pocket that much more. So effectively what they've done is, by not doing that, they've saved $2,000 from doing that. Now that we're narrowing that gap, right? That delta is like about 30 basis points in many cases. There's more of a reason to have a look at what to do. And it doesn't necessarily mean it's a 5-year fix, guys. Like we've talked about this. It could be some shorter term fixed rates that are out there. Although that yield curve is also getting pretty flat. Matt, Nick, you probably have seen that in some of the data you looked at. Like some of those 2-3 year rates now have caught up to the 5-year rate. And what that could mean is that there could be a softening coming. We don't know, right? But there's not a huge dip in lower rates versus lower terms versus higher terms. It's now starting to flatten a little bit. So now's a good time to chat. That's essentially my message here.
Yeah, and I think that we've done math, and to your point, the math is important in how much cash flow you have, but risk appetite is something that you can't really, it's not tangible to look at, and every person's risk appetite is a little bit different. So some people are already losing sleep just not knowing what's going to happen, and I have other people that are like, you know what? I kind of want to wait and see. And those are the people that have money in stocks and they've invested in Bitcoin. They clearly enjoy the risk a little bit, and they're not afraid, and you know they probably have a little bit of capital behind them that they know they can rely on. So it's there's the math, but then there's also logic and your own risk appetite and how you're feeling. If you said earlier when we spoke, Vince, if you can't sleep because you can't eat, and I thought that was a really good analogy. If you're stressing about paying for groceries, and it'll just give you peace of mind to lock in and just know it's not going to change, and then you can budget your life around it, how much you're going to spend on groceries, going out, maybe you make some arrangements for childcare, but then you know you've set it and it's done for a little while. So
I think we've all talked on, we touch base as a team every week, sometimes twice a week. This topic does come up. And at the end of the day, we don't want to see any clients suffer in a bad spot. We want to make sure that we're there for them. So it's really about having a discussion. For a lot of clients, it's just fear, right? They feel they're afraid because they're afraid of the unknown. So we do kind of tell them to, ease up on the media intake, and to let's look at a little bit of let's crunch some numbers and talk about your situation and not the situation of everyone else that is in the limelight, because at the end of the day, it's your situation that matters most. So, and we break those numbers down, and for the large part, I mean, most part clients are okay. They'll say, okay, I feel better now that we've gone through the numbers, and I'm gonna either stay put, or we have a different plan now and we're going to move forward. One of the plans that either one of the options that Matt discussed and explained, but at the end of the day, it's just about going through it with every client. I think that's the most important piece.
Exactly.
Cass, I got a little graph here. I think we can show everyone.
Sure.
It's the spread between fixed and variable rates. So if we focus in on the tail end of this graph here, anytime somebody entered into a mortgage after 2010, it's fairly obvious that the right choice was to go variable because the spread between the two were so big. But at the very end, we can see where we're at now. You can see that the fixed rate, there is a time period where it was lower than what the variable rate currently is. But all this time before, we encouraged our clients to save that money, put it against their mortgage, create a rainy day fund, is now a time where they can utilize that money. But there is a small portion there where people think that, oh, I should have went into fixed. And as Vince just described, it might not have been the best option, but it also determines of their suitability, other suitability factors.
So looking at this graph, to me, it looks like fairly shortly, the variable could be more expensive than the fixed. And it looks like it's happened very rarely in history. Like the last time would have been around 1990, late 80s to 1990. Vince, do you see that happening? The variable going higher than the fixed?
It could, yeah. And remember, what I tell people is don't get hung up on sticker price. Like with the end of the day, that price will change over the term of your mortgage. If someone were to sign up, let's say at the time, let's look at before 1990, let's look at 88, where the variable went up. Right there, yeah. If you were to be able to draw a 5-year line all the way across at a fixed rate, look what happens, right? You're signed up, and as rates come down, you are overpaying. So we can't look at it from that perspective. All we can do, and by the way, Nick, I think you probably just whipped this up as we were chatting, which is amazing. But all we're saying is that this convergence of rate is a good reason for us to chat with every single client, and that's probably the reason why we're seeing so many people call.
We talked a little bit about the interest rate differential penalty. I just thought it'd be a good idea to recap on the variable penalty so people know when they're comparing apples to apples or oranges to oranges, what is the variable rate penalty like?
Mateo, go for it.
So variable rate penalty, first of all, Nick, you're a superstar, buddy.
Yeah.
To do that on the fly in the background, what a ninja.
This
Incredible.
is why he's here.
The graph ninja. I love it. It's a data ninja.
So a variable rate penalty is going to be based off of, traditionally speaking, typically speaking, 3 months of interest. So you would take the balance of your mortgage and you would multiply that out by your current interest rate, and then you can either divide it by 4, or you can divide it by 12 and then multiply it by 3. Either way, you're getting 3 months of interest on what your annual interest rate would be on the current principal balance of your mortgage. So it's predictable. It's easy to calculate. You don't need any special training to do any of that. You don't need any special software to do any of that. It's pretty easy stuff. By comparison, the IRD, the interest rate differential, is exclusive to fixed rates. They are almost always going to be higher in cost than what the 3 months of interest would be by comparison on a variable mortgage. In recent times, we have seen times where they are 10 to 12 times higher than what 3 months of interest is. It might not be that case right now, simply because the spread between variable and fixed isn't quite as high. But that said, it is still going to be higher almost every time versus the 3 months of interest, I would say comfortably.
Also, point to, I don't know what happened to Cass there, but I'm sure she'll join back in. But
Speaking of ninjas.
Yeah, speaking of ninjas. One thing to note as well is that not every lender calculates their IRD penalties the same, right? So
that's right.
And we're always sensitive to that when we're placing someone to a fixed, even from the get-go, or if we're converting them to a fixed, there would be a discussion about either visiting the same lender that you're currently with, or maybe doing a combination of switching lenders at that point in time to avoid a more expensive IRD penalty and getting into something that's more favorable. So really important to point that out too. That just came to mind.
Yeah, there's always a couple of little things you can do along the way. I know that we encourage, as long as affordability lends itself to, but if there's the ability to make a lump sum payment prior to switching anything out and having a smaller balance that you are then paying a potential penalty on, we're not opposed to maneuvering things along that way either.
True. We've been known to do a little ninja on the ninja action on the mortgage as well. So
That's right.
Okay, you know what? I don't think Cassandra's jumped back on, and I don't know, maybe her. I know she was having some network issues earlier today, so perhaps she's not been able to jump back on. So I'll just I think we're going to end it here for now. Cool. On our part 2 and our update on the state of the interest rates. And how they're affecting our clients. And so we remain open for discussion. If you haven't heard from anyone on the team yet, you will be hearing from us. And you've got a variable rate, sorry. So if you've got a variable rate with us and you haven't heard from us, you will be hearing from us. We'll be reaching out to you to have a discussion just to see and make sure that we're still in the most suitable solution. And at least have a discussion so that and you've heard from us and run some math and have the ability to ask your questions. So thank you so much, Matt, for the information, the insight. Always appreciate the value you bring to the team and to every client. Nick, the newly coined ninja, we appreciate what you've brought to the team as well, and all the data analysis, the analytics, and everything else you've been doing. And look, we've got Cassandra jumping back in. As I wrap up, we're going to let her jump in, and we're going to say thank you to Cassandra as well for joining back. I was just
Sorry,
doing the
guys,
rounds.
what happened?
No worries. I was just doing the rounds and saying goodbye. So I just wanted to. I've already said thank you to Matt and Nick. And any last words, Cassandra, for you, since we're going to put you on the spot? You just jump back in.
My last words are, can't wait to talk to everyone, because I'm sure we got a lot of discussions coming up soon. So I'm going to rest my voice tonight, because I know I'm going to be on the phones pretty steady in the next couple of weeks.
Excellent. Thank you so much, everyone. Have a nice day.
Thanks, guys. Bye.
Thank you.